Welcome everybody, my name is Paul Sanchez. I'm a partner at Terra Rosa Family Office with Christian. This is my fund. I'm going to talk to you a little bit about it today and see if we can get some interest. Today we'll discuss a topic that has become increasingly relevant for investors, market neutral strategies in crypto markets. The focus of this discussion is not speculation on crypto prices, but rather structural opportunities created by market inefficiencies. We'll walk through how these inefficiencies exist, how arbitrage captures them, and why diversification across strategies matters. Here's all legal stuff. We're not a broker-dealer, we're not a licensed firm, but we are a hedge fund that's ran by the SEC compliance stuff. So, today we'll walk through a few key ideas around market-neutral strategies in crypto. We'll start with how traditional portfolios are built and why assets that look diversified can still end up sharing similar risk. Then we'll cover alpha and market neutral strategies and why investors look for returns that are not dependent on market direction. Next, we'll look at why crypto market structure creates opportunity and how arbitrage strategies captures those inefficiencies. Finally, we'll discuss why diversification across arbitrage strategies matters and walk through a case study and multiple strategy approach. A little bit about myself. I was an executive headhunter for 29 plus years. I placed all C-level people, board members, CFOs, publicly traded companies, helped take companies public, built strategies for Sarbanes-Oxley with companies, and raised a lot of money for the CFOs and brought in that. And then about 8 years ago, I was approached by a company that needed a CEO for a crypto company. And they said, "Can you find me somebody?" I said, "Of course, that's what I do." So I found them the top guy in the nation. He actually signed the very first 10Q, 10K for the first publicly traded crypto company. That didn't work out. He didn't get hired. But he was running a hedge fund at the time, and it was a blockchain. He concentrated on blockchain fintech solutions, and he asked me if I wanted to do some business development, basically raise money for him. And so I got into my Rolodex and started raising money for him, and raised them millions of dollars right away. I've been involved with him ever since. And then about 4.5 years ago, he started a new company, a new project, and I raised the equity for that. And that's kind of what brought us to this point here that I'll explain a little bit more about it. Then about a year ago, I was doing some other stuff, and I got a call from Christian over here, our chairman of Terra Rosa, and he said, "I'd like to come on board and help us do some things, especially with a company called that fully owned by Terra Rosa called OTech." And I said, "Sure." And what we do there is we help companies build funds and then also do fundraise for them. And I was presenting to companies about building funds and doing fund incubation and talking to the attorneys and learning that kind of stuff. And then the light bulb came on and said, why don't I white label what I did with the other fund company that I was doing, that I built the equity for, and bring it over here and start my own hedge fund and just do the same thing that I've been helping other companies do, and then raise some money and do that. So that's where Zenith was born. It was born from me raising money for another company. They can no longer take in individual investors, only institutional people. So now any kind of individuals that come through for them, they'll send them to me over here at Zenith, and that's what we do. So a little bit about me. Most traditional portfolios are built around three main buckets: stocks, bonds, alternatives. On paper, these look diversified. Each asset class behaves differently during normal market conditions. But during market stress, something interesting happens. Correlations increase, and many assets begin to move in the same direction. In other words, assets that appear diversified can end up sharing the same underlying risk exposure. That's why many investors look for return sources that are structurally different and less dependent on market direction. That leads us to the next question. Where can those type of returns come from? And that brings us to the concept of alpha. If we step back and look across the major assets classes, each one offers a different trade-off between return and risk. Treasury bonds tend to offer stability, but the return potential is relatively limited, as we all know. Equities historically provide strong long-term growth, but they also come with a significantly volatile and drawdown risk during market cycles. Real estate can offer diversification, but the recovery periods after downturns can take several years. I'm sure people have invested in real estate and know what I'm talking about there. And then there's crypto assets, while potentially offering high upside, can experience extreme volatility and unpredictable drawdowns. About 10 weeks ago, we saw the crypto markets where it was up over 100 and dropped down to the mid-60s and down to 60, and people that were in Bitcoin just freaked out over that. You know, we all think that's going to go really high, and I do believe still this year Bitcoin will see $150,000, but that's what happens with crypto markets. Great upside, but then it can crash, and we saw what happened with that. A lot of people were hurting. So the key takeaway is that most assets sit somewhere along the spectrum of risk versus return, and investors often end up taking more directional risk in order to pursue higher returns. That's why many sophisticated investors start looking for something different. This brings us to the concept of alpha, which is a term used frequently in institutional investing. In simple terms, alpha refers to returns generated through skill, strategy, or structural advantage, not simply because markets are rising. When markets move broadly upward, most assets benefit. That's what we call market beta, where essentially all boats rise. Alpha is different. It comes from identifying inefficiencies or advantages that allow returns to be generated regardless of market direction. These opportunities usually come from structural inefficiencies, disciplined execution, and systematic strategies. One category strategy designed to capture alpha is what we call market neutral investing. One way investors pursue alpha is through market neutral strategies. The goal here is to structure positions so that overall market direction has minimal impact on the outcome. This is typically done by combining long and short-term positions, which helps offset directional exposure. Instead of relying on just markets going up or down, the strategy focuses on price relationships and spreads between assets or markets. As a result, performance can come from how markets function and where inefficiencies appear, rather than from broad market movements. So naturally, the question becomes, where do those inefficiencies actually come from? And that's where market structure starts to matter. Once we understand that inefficiencies exist in markets, the next question becomes, how can those opportunities be captured? In fragmented markets, particularly crypto, the same asset can trade slightly different prices across venues, creating temporarily price gaps. But identifying those gaps alone isn't enough. You got to be able to capture them consistently, and that requires disciplined, systematic framework. That's where arbitrage comes in. Not as speculation, but as structural mechanisms for harvesting price spreads across markets. In other words, the focus shifts from predicting prices to systematically capturing inefficiencies as they appear. So let's take a look at these arbitrage opportunities and where they actually come from in crypto markets. Crypto markets are highly fragmented, with many exchanges and trading venues operating globally. This fragmentation naturally creates price differences and structural inefficiencies. One example is single exchange arbitrage, where the same asset may trade at slightly different prices across exchanges, creating temporary opportunities. That's what we've actually mastered. Another source comes from relationships between spot markets and future markets, where differences, fund rates, or future prices can create arbitrage spreads. The third as a source involves cross-venue settlement and liquidity differences, where timing and liquidity imbalances across markets create additional opportunities. Where these opportunities come from different sources, they generally fall into a few core strategies. One is liquidity fragmentation arbitrage, which targets inefficiencies that appear when liquidity is uneven across different exchanges or order books. Number two, funding and basis arbitrage, which captures yield created by relationships between spot markets and derivative markets. Number three, which we do very good, is single exchange arbitrage, which captures price differences between trading venues of buying and selling assets simultaneously. We'll discuss this during question and answers. We'll be asking a lot of questions about this, I'm sure. Each of these strategies focus on structural market inefficiencies rather than directional speculation. Alpha. Since these strategies behave differently, it's useful to compare their characteristics. At a high level, these three arbitrage categories each offer different mix of risk, consistency, and liquidity. Single exchange arbitrage tends to be relatively efficient and liquid, which can make a strong source of consistent opportunity. You can see there's a very low risk in what we do in single exchange arbitrage, and the returns are definitely high. Liquidity is high. Funding and basis arbitrage is typically more yield-oriented, with returns driven by relationships between spot and derivative markets. Liquidity fragmentation arbitrage can be especially attractive when markets become uneven, but may depend more on specific market conditions than depth. The key point that each strategy contributes something different. That's why combining them can create a balance and resiliency. And once you see that each strategy behaves differently, the next question becomes, why not combine them? Which is the thought. If an investor relies on single arbitrage strategy, performance can become dependent on one specific type of opportunity. When an opportunity becomes less active, a strategy may face higher volatility, periods of lower returns. By contrast, multi-strategy approach spreads capital across different arbitrage strategies, each driven by different markets. Because these strategies respond differently to inefficiencies, the risk tends to not move together the same way. The result typically is stable performance and reduces concentration risk. Single arbitrage exchange is what we really concentrate on here. It's what we have really mastered. So at the company that I did the raise the equity for, that's all they do. We buy and sell Bitcoin in a high frequency trade across different exchanges. We'll buy it on one exchange, Binance in Europe, and sell on another exchange in Kraken in Brazil. And as you know, Bitcoin is not like regular stocks. Sometimes you can get hundreds of dollars difference instead of just cents. So we make a lot, the profit there is, you make a lot more with less trades. And that's what we've mastered. We've got that down. It does it as a blink of an eye. Our systems were built by the director of NSA for digital markets, very master mindful person that has been working with crypto for a long time. Our CEO has done a lot of crypto stuff for years, and one of the forerunners of crypto markets way back when it first started.